Now, the other thing that I said about the milkshake was that it would have a huge impact on bonds. And in fact, I thought rates would rise after a 40-year bull market in bonds. And it's the rates rising that would cause treasuries to go down, and it would cause the dollar to go up, because as interest rates go up, it makes the dollar more attractive because you need dollars anyway. And, you get paid more to hold dollars, and then et cetera, et cetera, et cetera. I'm not going to go through the whole thing again. Rates rising and US treasuries falling was a huge part of it. The whole thesis was about a sovereign debt crisis. A sovereign debt crisis is a process via which sovereign bonds get sold. In other words, treasuries get sold, but other foreign bonds get sold as well. And as investors want to leave bonds, as they no longer trust sovereign bonds, they have to find new places to put that capital. And the place we said that they would put that capital would be US equities and gold, and potentially some other places as well. Again, this is all in the original interview. I'll put a link to the interview in the description of this video here. And this is where I said bonds would fall. Now, initially, I was wrong. During the early stages of COVID, treasuries rallied, but then after that, they've been coming down ever since. So that is largely what has happened. I will say, I have often said the U.S. Treasury will be the last one to actually go default. In other words, other sovereign bonds will default long before the United States does. That is not the same thing as saying that treasuries are going to rally and interest rates are going to fall. In a sovereign debt crisis, all bonds can fall, all rates can rise. My point has always been, if the United States cannot get financing, then China cannot get financing, France cannot get financing, Turkey cannot get financing, Australia, et cetera, et cetera, et cetera. It's a relative. Now, the other thing is I tried to explain as well as possible that I was going to walk in explaining the thesis. I was going to walk through it in a linear fashion, in a way of telling a story in order for it to make the most sense. But I clarified in the interview, not necessarily going to happen in a linear fashion like this. One thing might happen before the other. I may get the order mixed up a little bit, but essentially I expect all of this stuff to be going on kind of at the same time. And listen, I get things wrong all the time. I'm not smart enough to know exactly how all of this is going to play out. But the point is that all of this stuff was going to kind of happen together. And whether one happened first or second, I didn't really care. This is the things that I expected to happen in the future as rates rose and sovereign bonds started to get rejected. The other thing that I made clear is that my thesis on gold had not changed at all. In fact, the dollar going higher, I thought there was nothing more bullish in the long term for gold than the dollar going higher, because the dollar going higher wrecks the system. And as the system gets wrecked, even though governments might not want to remonetize gold, gold will raise its hand as the price rises and saying, see, I'm right here. You can use me if you're ready or if you want to. And so I've always said that gold would do very well. And, people ask me, I've always said gold is going to go to at least $5,000. It's probably going to go higher than that, but it's going to go to at least 5,000. I have never changed that once. And I've said everybody should always own gold. Gold is one of the bedrocks of every portfolio. So this idea that gold doing well now and replacing treasuries is somehow anti-milkshake is just completely wrong. Treasuries getting sold and gold getting bought is literally part of the milkshake, and it always has been. And again, you can go back and look at the original interview and decide for yourself. The other thing is I said that I thought when gold really started to make its move, it would be driven by foreign buying, not U.S. buying. And the reason is because when a country's currency starts to lose value and go into crisis, that is when those investors really start to buy gold. And in 2022, when the dollar was really high and everybody else's currency was really low, that's when the rest of the world really started to buy gold. And then as the dollar started to weaken, it got since 2022, it really got a tailwind. But since we first started talking about it, the dollar is higher than it was, gold is higher than it was, US equities are higher than they were. And so this is all kind of playing out. But the point is it's been driven by China buying, by Europe buying, by Asian countries buying. It has not been driven higher by US investors. It's not to say the US investors aren't participating, and it's not to say they're not buying, but that has not been the primary buyer. The primary buyer, the slide that we started off with, it's foreign central banks buying and foreigners buying. And a lot of the reason that China's buying is people that don't wake up in China and say, Jay Powell is out of control, I'm going to go buy some gold. They buy gold because they don't trust the yuan. That is why they buy gold. But anyway, the foreign buying of gold has certainly played out. And the other thing, probably the most controversial part of the whole first interview that I gave was I said, dollars and gold will rise together. And some people have said, of course, that cannot happen. Dollars and gold trade opposite each other. You cannot say the dollar's getting strong if gold is rising because that proves that the dollar's weak. I literally explained this in the very first interview, that what I was talking about the dollar rising, I was talking about its foreign currency peers, fiat currency peers. We have a couple different ways that you can subscribe to our research. If you go to research.santiagocapital.com, there's a couple different levels. There's our main level, which gives you access to a number of different reports. And then there's the premium version, which gives you access to even more reports, more in-depth reports. A couple times a month, we do a live Q&A, and you get access to basically everything we do.